Good evening. Tonight, we take you to the heart of the financial world, where the mood was anything but calm as a new trading day began. Wall Street started the day on edge, with U.S. stock index futures flashing red before the opening bell. The air was thick with anticipation, as traders and investors braced for what could be a pivotal session. At 5:10 a.m. Eastern, S&P 500 E-minis were down 12 points. Dow E-minis slid 83, signaling a cautious start. These early moves set the tone for the hours ahead, as market participants tried to read the tea leaves. And Nasdaq 100 E-minis dropped 57, adding to the sense of unease. The declines weren't dramatic, but they were enough to keep everyone on their toes. These aren't panic-level drops, but they signal investors are cautious ahead of a crucial earnings season for big banks. The mood was one of nervous anticipation, as the market waited for fresh clues. The financial world was holding its breath, waiting for America's largest banks to reveal how they fared last quarter, a health check for the entire economy. Bank earnings often set the tone for the rest of the market, and this season was no exception. The mood was further dampened by JPMorgan Chase's warning about a proposed cap on credit card interest rates, which could tighten access to credit and squeeze bank profits. Such regulatory moves have the potential to ripple through the entire financial sector. This regulatory uncertainty added another layer of anxiety to an already tense market. Investors were left wondering how new rules might impact lending, spending, and the broader economy. As the sun rose over New York on January 14, 2026, investors weren't panicking. They were waiting, watching, and bracing for a flood of data. The city's financial district buzzed with cautious energy as everyone prepared for the day's revelations. The slight dip in futures reflected a market in pause mode, not freefall. It was a moment of collective breath-holding as traders weighed risks and opportunities. Investors were searching for clues in bank earnings, hoping to spot early signs of strength or weakness in the financial system. And a slate of economic reports and official speeches promised to add even more fuel to the day's uncertainty. Every data point, every word from policymakers could tip the balance. It was a classic wait-and-see moment, with the next move hinging on the hard facts about to hit the wires. The entire market seemed to be holding its breath, waiting for the signal to act. The stakes? Nothing less than the direction of the U.S. economy. In these moments, every tick of the market, every headline, and every analyst's prediction could shape the path forward for Wall Street and Main Street alike.
Today's anxiety centers on Citigroup, Bank of America, and Wells Fargo, giants whose results ripple through the entire economy. Their earnings are a real-time checkup on lending, mortgages, and consumer health. Pre-market trading showed Bank of America shares inching up, while Citigroup and Wells Fargo edged lower, reflecting mixed investor sentiment. Investors are dissecting each bank's unique strengths and risks, not treating the sector as a monolith.
The results from these banks are more than numbers. They're a bellwether for the market and the economy. A strong showing could spark confidence. A weak one could trigger a sell-off. That's why all eyes are on these financial titans today.
Wall Street analysts are closely watching for a revival in deal-making as a key theme this earnings season, with many expecting a significant jump in investment banking fees. After a period of sluggish activity, the hope is that a wave of new deals and mergers will signal a turning point for the industry. If this materializes, it would be a clear sign of renewed corporate confidence, which in turn could provide a much-needed boost to bank profits and set a positive tone for the rest of the year.
The optimism isn't limited to banks. Analysts are forecasting S&P 500 earnings growth of 8.8% for Q4. Which would cap off a remarkably strong year for the broader market and reinforce the narrative of economic resilience. This surge in profits has been a major driver behind the market's climb to new highs, fueling investor enthusiasm and pushing stocks further into record territory.
But not all is rosy. JPMorgan's recent warning about a potential cap on credit card rates has cast a shadow over the sector, highlighting the very real risks posed by changing regulations and government intervention. Markets hate uncertainty, and this regulatory issue has tempered enthusiasm for financial stocks, causing some investors to pull back and reassess their positions.
For everyday investors, the experts remain split. On one hand, there's strong data-driven optimism about future growth and earnings potential. But on the other, there are real regulatory and economic concerns that can't be ignored, especially as new policies and global uncertainties emerge. This constant push and pull between optimism and caution helps explain why futures can dip, even when forecasts are overwhelmingly positive, reflecting the market's underlying anxiety. Investors are left weighing the good against the bad, trying to decide which narrative will ultimately win out and shape the next phase of the market. In the end, the market's mood is as mixed as the headlines, with every new development adding another layer of complexity to an already uncertain landscape.
Bank earnings are just one piece of today's complex economic puzzle. While they offer a glimpse into the health of the financial sector, they don't tell the whole story about where the economy is headed. Investors are also bracing for the latest producer price index and retail sales data, two key indicators that help paint a broader picture of inflation and consumer spending patterns across the country. Rising producer prices can foreshadow higher consumer inflation, signaling that costs may soon be passed on to shoppers. Meanwhile, strong retail sales reveal the resilience and confidence of American consumers, who drive much of the nation's economic growth.
These reports will either confirm or challenge the story told by bank earnings about consumer health, offering new clues about the direction of the economy. The prevailing narrative has been a soft landing, the hope that the Federal Reserve can tame inflation without triggering a recession, keeping the economy on a steady path. So far, the data has supported this optimistic view. Growth continues, jobs remain strong, and inflation is gradually cooling, giving both policymakers and investors reasons to be hopeful. Each new data point is a test of that optimism, and markets react quickly to any sign that the story might be changing. For investors, these numbers aren't just abstract. They directly influence the long-term performance of your investments, retirement accounts, and even your financial security. A strong economy lifts profits and stocks, creating opportunities for growth. A weak one does the opposite, leading to uncertainty and potential losses. That's why Wall Street obsesses over every data release, knowing that even a small surprise can shift the market's direction. The stakes are personal for anyone with money in the market, because behind every chart and headline, real people's futures are on the line.
No market discussion is complete without the Federal Reserve.
The Fed's control of interest rates shapes the entire economy. Raising rates cools inflation, cutting them spurs growth.
The big question now isn't if the Fed will cut rates, but when and by how much. Today, several key Fed officials are speaking, and investors will parse every word for clues.
The market expects rates to stay steady through mid-2026, with cuts likely in the second half. This expectation has fueled the stock rally, as lower rates make stocks more attractive.
Any shift in this timeline could spark volatility?
For investors, Fed policy impacts everything from mortgages to credit cards to stock prices.
The Fed's path will dominate the market narrative all year. Global events can jolt markets in an instant.
Today, U.S. cybersecurity stocks like Palo Alto Networks and Fortinet tumbled after China told domestic firms to stop using certain U.S. and Israeli software.
This is part of the tech decoupling trend. US and China, reducing reliance on each other's technology. For American firms, losing access to China is a major blow to growth prospects.
The stock drop reflects investors' quick recalculation of future earnings.
Meanwhile, a high-stakes White House meeting with Denmark and Greenland looms as the US eyes Greenland's rare earth minerals.
Control over these resources is a strategic issue, with real financial implications for mining and defense stocks.
Any escalation could disrupt commodity prices and global supply chains.
Savvy investors know that geopolitical moves in Beijing or the Arctic can send shockwaves through portfolios. In today's interconnected world, politics and profits are inseparable.
Despite market jitters, artificial intelligence remains a powerful updraft for stocks. AI leaders and chip makers have soared, driving the market's strong performance.
The belief in AI's transformative potential keeps investors committed, even amid uncertainty.
This optimism acts as a counterweight to negative news, but it also creates risks. Heavy reliance on a handful of tech giants means the market is vulnerable to shocks, like today's China news hitting cybersecurity stocks.
The tech sector's strength is also its weakness. Concentrated gains mean concentrated risks.
For investors, the challenge is to ride the AI wave without ignoring the dangers of a narrow, volatile rally. The story of innovation is compelling, but diversification is key.
Don't let the promise of AI blind you to the sector's unique vulnerabilities.
For much of last year, a few tech giants drove most of the market's gains.
This narrow rally raised concerns about market health.
Now, there are signs the rally is broadening. Mid-cap and small-cap indexes are outperforming the S&P 500.
This suggests growing investor confidence and a healthier, more sustainable advance.
Smaller companies benefit most from economic optimism and expected Fed rate cuts.
For everyday investors, this is a trend to watch. Diversification is essential.
The rise of small and mid-cap stocks signals a more resilient market.
A broadening rally means more opportunities and a sturdier foundation for the bull market. The market's strength is no longer just about the tech titans. We've covered nervous futures, bank earnings, Fed moves, and global drama, but why does it matter to you? Every headline, from a dip in futures to a policy shift in Beijing, affects your 401k, IRA, and investments. Bank earnings reflect Main Street's health, not just Wall Street's profits. The Fed's decisions shape your mortgage, savings, and credit card rates. Watching how markets react to news teaches the value of diversification and long-term thinking. Don't panic over daily headlines. Focus on the bigger trends and build a resilient investment strategy. The goal: see the whole field, not just the player with the ball.